Well, hello, good morning, good afternoon, wherever you are. I'm Rob Atkinson. I'm president of the Information Technology and Innovation Foundation, a think tank in DC. And ITIF has been long focused on productivity and the whole idea that the only way we're going to improve global living standards is through raising productivity. And that doesn't mean working more hours or working in sweatshops. It means figuring out ways to reorganize and structure work and to use technology so that average output per worker goes up and we're all richer. Unfortunately, this is an issue that gets very little attention, frankly. If you listen to most of the media, typical financial or business news show or article, they're almost nothing about productivity. They're about what's going to happen to the debt ceiling, what's going to happen to interest rates, what's unemployment. They're all very short-term oriented. And so we're really pleased today to have a really great panel to talk about this issue. As Paul Krugman said, productivity isn't productivity is essentially everything about growth. What stimulated this conversation was a new report that I happened to read from McKinsey and Company on productivity, what's happening in the U.S. and how it's growing and what are the challenges. And so we're really pleased that Charles Atkins, who's a partner at McKinsey, will be kicking us off with opening remarks. Charles has experience across a broad range of issues of strategy and marketing and sales and operations, particularly in technology sectors. He works with leading technology companies to accelerate growth. And he was also part of the McKinsey Global Institute, where he published on a range of issues, including macro trends of the debt crisis, African economic growth, and financial market development. Joining after Charles is Luca Marcolin. Luca is a senior economist at the OECD in Paris and a research fellow at KU Leuven. And he coordinates the OECD Global Forum on Productivity. And the OECD has been doing leading edge work on this whole question of why is there a productivity slowdown among the OECD nations? What's the cause of it? And most importantly, what can we all do about it? His main interests, including analysis of firm capabilities, which includes technology adoption, intangible assets, and skills. And I really can't stress that enough, that most of economics, frankly, ignores firm capabilities. It just ignores them, and it just focuses on prices in markets. And yet, at the end of the day, firm capabilities are the most important thing we need to be thinking about. His prior experience was at the European Bank for Regional Development, European Commission, UNCTAD, and the World Bank. So with that, over to you, Charles.
Thank you, Rob. I'm delighted to be here. So I'm going to kick it off by talking about a report that the McKinsey Global Institute published in February this year titled Rekindling US Productivity for a New Era. And the genesis of this report was, of course, productivity has been a central theme of the work of McKinsey Global Institute dating back to the early 90s. And the reason being, as Rob mentioned at the start, that over the long-term trend of history, growing productivity is the surest way that we make societies more productive, that we increase the welfare and living standards broadly across our economy. And in the US context in particular, since 2005, labor productivity had been slumping and declined after what had been really a boom time over 95 to 2005. And then we had the global pandemic, onset in 2020, which really created, a very volatile and uncertain period around productivity growth. And so as we reemerge from the pandemic, the question was, well, what is the outlook for productivity and how much does it matter toward the sort of future evolution of the US economy? And so we published this report to really try to synthesize what we can say about where we've come from in terms of productivity, and more importantly, what are some of the trends and challenges that we face in terms of unlocking future productivity growth? And really, there were sort of four main messages coming from the work. First of all, we started by framing what the productivity opportunity is. And we found that if the US can grow at historical rates of productivity, which have averaged about 2.2% annually in labor productivity improvements since 1948, if we can restore that growth, that represents around a $10 trillion incremental growth opportunity for the US economy, cumulatively from now to 2030. So it's a substantial number. And when we look at, well, what is that going to take to unlock? We started to look at the US economy through a number of lenses, through the lens of different sectors, different firms, different states, and ultimately cities as well. And what emerges is a picture of, the have and have nots of productivity. In some areas we have done tremendously well, in line with historical, even exceeding historical growth rates, but in others we've lagged behind. And understanding the reasons behind those patterns may unlock important lessons for what it's going to take to really unlock more productivity growth moving forward. But then, looking forwards, we then sort of highlight in a third set of key messages that we do face a number of looming challenges, which will both in some measures make productivity growth more difficult, but also raise the importance of productivity to help us, as a society, meet challenges like aging populations or our debt and entitlements burdens. And so lastly, in the report, we start to frame a few actions that both business leaders and policymakers could consider in terms of how to really start to make a difference within their organizations and within society broadly, or the economy broadly, for productivity growth. So really starting with the longitudinal picture, what emerges if we look since the data set begins in 1948 at long-term trends in labor productivity growth, what you see is that labor productivity over time has been incredibly cyclical. And what we see is that since World War II, we've averaged labor productivity growth of about 2.2%. And while that goes up and that goes down, since 2005, we've really been quite far below the trend line, over that period. In fact, since 2005, our average productivity growth has been around 1.4%. And so that difference, while seemingly small, actually adds up to quite a significant difference in overall living standards and output over the long term. Secondly, what's also compounded the impact of that slowdown in productivity growth is, while through much of the history, you'll see the dark blue line here, which is the labor productivity growth, and the light blue line, which is the sort of average real compensation, have largely tracked each other over time. But over the last sort of 2 decades, what's really happened is that real compensation growth has not quite kept up with productivity growth as well. So in as much as productivity has slowed, so has real compensation, and the two have become, while still connected, more loosely connected than over much of the long-term US history. And so that's added pressure to the importance of productivity, as we haven't seen living standards growing at quite the rate that we've become accustomed to in the US economy and the US context. So clearly there's a real issue to be solved. What we then wanted to understand is, well, what's the value of us solving them? And we found that if we could return the US to essentially its 2.2% post-war average over the next roughly 9 years since the data ended in 2021, and we looked ahead to 2030, that would be worth roughly $10 trillion in cumulative GDP that would be added over that period. So that's a substantial number just in terms of aggregate output that would be added to the US economy. But to make that more real and tangible, what that translates to is about $15,000 additional output per household in the year 2030, which, when you put it in the context of during the pandemic, we had stimulus checks of $3,000 to $5,000 per household in the US, which was considered a big deal at the time. This says, with this improved productivity growth, it really is a multiple times that in terms of the additional value that would accrue to households. And so, really, this is a huge issue for the US, and the prize for being able to unlock more productivity is potentially quite transformative to our society. So next, we wanted to understand, well, what's it going to take to get there? And really, to understand that, we started to look at the US economy through a few lenses to understand those productivity trends. And we started by looking at the picture across US states. And what emerges, if you look at the trends in labor productivity levels and growth since 2007, we looked at it from 2007 to 2019, is you see some very interesting patterns emerge. What we find, if you look at the levels of productivity by state, which is really on the x-axis of this graph, you actually see quite significant differences across the productivity levels, with the highest states like New York being almost 2x or roughly 2x the productivity levels of the the lowest productivity states. And so that's quite a substantial difference indeed. But in addition to that, what was really interesting was we saw quite significant differences in growth rates of productivity as well. And through much of US history, the academic literature highlights that in the US, we've tended to see convergence in real GDP per capita within a state level, and imputed through that some productivity measures at a state level. What we've seen over the last decade and a half is really that convergence has stopped, and over the last few years even started to diverge by some measures. And so one of the puzzles is, what is it that's driving a handful of states in the top right-hand corner of this chart that have really pulled away? And we looked at sector mix, of course, as one potential driver, and certainly you'll see North Dakota right at the top of this chart, and the oil and gas boom has certainly benefited that state significantly. But when you look at the other states on the top right-hand corner, it's not at all clear that sector mix actually explains a lot of the growth outperformance that they've had. And so clearly there's something else going on that is driving some of that productivity trend, across these different states, which was quite surprising and quite interesting for us. Next, we actually looked at sectors and said, look, we understand that sectors could explain some of the state level performance, but let's have a look and see how different sectors have performed over the last 15 years, between 2005 and 2019. And what you see is that there have indeed been a set of sectors that have disproportionately performed well. Mining, which includes oil and gas being foremost among them, but also sectors like information, which includes a lot of the software industry, which has had so much press about it over the last few years, which is not surprisingly really boomed over the last decade and a half. And so we've seen these leading sectors that have both started at a high level of productivity, but actually grown even more productive over the last decade and a half. And those are quite promising stories indeed. The trouble is, if you look at the right-hand side, those sectors in the dark blue only represent less than 15% of working hours in the economy. So while we've had these sectors that have outperformed and benefited, they don't represent a high share of employment. And instead, when you look at where the preponderance of our labor force is employed, you look at the bottom two groups in this chart, what we call the growing sectors and the lagging sectors. Both of whom start from a relatively low level of productivity within those sectors, and in the growing sectors case have started to make some improvement, but in the lagging sectors case have really not driven much of a change in productivity at all. And so it's clear that if we really want to move a significant portion of the US economy in terms of its overall productivity, we need to figure out how do we accelerate the productivity growth in some of these growing sectors, and how do we ignite it in some of these lagging sectors, which have tended to include some sectors that have persistently been hard to shift productivity, healthcare being one, construction being another. So that's clearly a second important lesson that we took from the research. Then we also looked within sectors, because it was quite interesting to look at, within each of these sectors, what's the degree to which we're seeing productivity shifts among firms and establishments within the sector level. And what we found was quite interesting. Using some of the establishment level data within manufacturing, we saw that the difference between what we call the frontier firms at the 10th percentile productivity or 90th percentile productivity, and the laggard firms at the 10th percentile, we saw that there was on average around 5.4% difference in that productivity level, which was quite astonishing. But more importantly, we also saw that gap has actually grown wider over time. And this is a finding that in several other pieces of academic work has been validated, across a range of different sectors and contexts. We see it in the technology sectors, we see it in service sectors as well. And so clearly one of the interesting patterns that we also need to understand is, while the differences between sectors is very great, in some measures the differences within sectors can be at least as large. And the real question is, why is it that we've seen these frontier firms that have grown, continue to grow much more productive, but the majority of firms within sectors have tended to slow down and stagnate and fallen further away from that productivity frontier. And clearly some of what we need to unlock in terms of how we unlock productivity growth will need to be about how do we bring more of those lagging firms closer to the productivity frontier through some combination of understanding how it is that they could benefit from technology, trade, and some of the other productivity uplifting factors. Lastly, we took a look at the city view because we wanted to bring together some of the spatial dimensions of what we were seeing in productivity with what we were seeing at a firm and sector level. And taking into account the largest 40 metropolitan statistical areas, what we saw was actually very much mirrored at the city level. And what we found was that there was a set of 8 cities here that began the period of 2007 at a higher level of average productivity and really took off over the last decade and a half. And those have been the cities that have disproportionately benefited. It's not surprising in some measure that many of these have benefited by having rich tech ecosystems. We see San Jose and San Francisco at the top, for example. But it's clear that there's a broader story at play here than just tech. And so really understanding what it is that's made these cities successful is also quite an important aspect of the future productivity formula. And by the same measure, why is it that some very large cities have been, on a relative basis, stagnating in terms of productivity? And what is it going to take to unlock the growth in some of the cities, in the middle or the bottom of this chart, particularly some of the very fast-growing cities like Las Vegas or Tampa or others, where the employment base is growing quite rapidly, but we haven't seen productivity necessarily catch up. And then the last thing that of course stands out as you look at this is of course where these cities ended in 2019 is by no means their destiny, in the sense that these cities are going to need to continue to innovate, and we know over the course of the pandemic, some of these cities, like San Francisco, near to where I am today, have been quite heavily impacted, and so it's going to be an interesting question to see will these cities continue to grow. So those really represented a set of patterns around productivity growth that really we saw a set of areas within the economy, certain states, sectors, firms, and cities that disproportionately grew faster. But the majority of the same areas where the economy was tending to fall behind. We then wanted to look forwards and say, well, what's the environment that we're confronting here as we think about what it's going to take to unlock future productivity growth? And it was clear that in general, as we look across sort of 5 domains impacting the economy, that in general we face some headwinds in terms of unlocking further growth. First of all, we've got clearly a set of workforce shortages, particularly around skilled labor, and all the data would suggest that being able to attract skilled labor into firms is part of the recipe for how to unlock productivity at the firm growth. And so as we continue to face shortages of skilled labor, that's going to be a key factor that we're going to need to address in terms of how we think about unlocking more productivity growth. Secondly, while there's been a lot of technology investment and technology continues to advance fast, any discussion today that I walk into in the technology sector, involves some discussion of generative AI or ChatGPT. But the reality is that even the technology that's broadly available today, the benefits have not been broadly captured. There've been some firms that have really invested and captured significant value from digital technology, but many others that have not seen the ROI, have not seen the value creation keep up with their levels of investment. And so the question is, how do we actually make sure that the technology benefits are more broadly shared? Thirdly, when we look at the environment that we were in from 2005 to 2019, after the financial crisis, we were really in an environment where we were in very favorable real interest rate environments. We had, over many of those years, quite low macroeconomic volatility or financial market volatility. And who knows how that's going to evolve moving forward, but it's likely that we're going to see much more volatility in asset prices, much more volatility in interest rate expectations. And so if anything, our investment environment could be more of a headwind than it has been. And so that poses a further challenge to how we then think about firms being able to make productivity enhancing investments. Fourth, as we think about one of the other big transitions and challenges that we face is really the energy transition. And one of the things that we will need to navigate over the next decade is how do we navigate that trade-off between the speed of transitioning our energy systems and the affordability and the productivity impacts of that. And there may be some real trade-offs there that we need to manage. And then lastly, we've looked at the sort of redrawing of the lines of globalization and some of the economic rules. And clearly there's been winners and losers that the last decade and a half have failed to account for. And in the future, as globalization and the rules of the global trading regime shift, there's going to be a need to better account for, those winners and losers and different people and places in how those rules get set. That may have implications on productivity, and I think it's too soon to tell exactly what those might be. But it's clear that as those rules get reevaluated, productivity is going to be, impacted to a more or less degree. And so, as we think about these sets of factors broadly, it struck us that these were 5 very important areas that we needed to kind of take note of and think about as we then factored in what is the productivity outlook that we see. And so within that, we very quickly, I'll cover a set of domains or areas that we then tee up for both business leaders and policymakers, really building on those domains. First of all, for business leaders, we really emphasize that there is much more that business can do to proactively prepare themselves for these talent shortages and the sort of the heating up of the war on talent. And that can change both new approaches on how you attract new talent into your organization, shifting from credentials to skill-based hiring, for example, but also how you start to really train and build capabilities, and how you set new policies that help retain some of the talented people that you already have within your organization, as well as how you can proactively, as a business leader, work with some of the public and social sector organizations within your area. Secondly, there's a set of imperatives around technology, and how do you actually capture the value from the technology investments that you are making and will continue to make, both in terms of how you reorganize your organization to take advantage of some of those capabilities, and how you retool and deploy technology to create value within your organization. Thirdly, a set of ideas around how do we balance the energy affordability and productivity trade-off. And then lastly, really a emphasis here around how business leaders can start to be more proactive about partnering with the public sector, social sector, and other private sector institutions to start to shape the local context and start to be proactive in making sure that they're creating ecosystems in which their firms can flourish. And then very quickly, we then similarly lay out some ideas from a policy making perspective, very much mirroring some of the same themes. We think there are a set of ideas around how do we really equip the workforce of the future, and we outline many of those ideas in the paper, including things like reskilling programs, but also how do we address things like non-compete laws and some of the other rules and regulations that make it hard for talent to migrate and for labor market mobility to really adjust optimally. Secondly, one of the really interesting things as we look at the technology investment has been around this notion of intangibles, that technology, the firms that have tended to benefit from technology have usually complemented those investments in hard technology assets with investments in intangibles, such as their own intellectual property, or even things like upskilling their own talent. And so how do we start to encourage intangible investment by continuing to update our policies around intellectual property and competition, and how do we continue to support some intangibles with public R&D, which has been such a catalyst for many of the technologies and innovation that we have today. And then thirdly, clearly the public sector is going to need to play a major role around managing the energy transition, and how do we start to manage large-scale capital deployment, but also how does the public sector help support the innovation around the area, and help address some of the trade-offs behind those. And then lastly, we teed up what has been at times like a controversial topic within economics, which is when we step back from much of the work that we've done to look at where we've seen productivity benefit, but also where we've seen some areas lagging behind. It's clear to us that there's a need to start to look more closely again at some of the what we call place-based policies, which have had a mixed track record over time. There've been clearly some success stories, but also a lot of areas where they haven't proven successful, and there's some real issues to be thought through around both the economic and political economy consequences of them. But given some of the areas where we do see in particular regions of the US, which have failed to spark productivity growth, but where we also see low rates of labor force participation, that becomes a real imperative to address for our economy. And we think it's worth taking a closer look at those and trying to understand, are there some generalizable lessons of success? So that's really the scope of the work that we've done. And I'd encourage anyone who's interested in reading further to visit our website to see the latest version of the report. And I think with that, we'll move to the panel discussion.
Great. Charles, that was fascinating. Before I turn it over to Luca for your remarks, let me just make two quick remarks. One is that $10 trillion figure is very compelling, and especially when you think about it in terms of approximately 20 cents of growth of GDP goes to the federal government through tax revenues. And you look at the massive size of the federal budget debt and the growing deficit. Imagine if the federal government was getting $2 trillion more. It would just be a completely different conversation. And yet, by and large, the sort of narrative in DC is sort of Miller Beard, tastes great, less filling. It's like, well, we'll cut taxes or we'll cut spending. Well, how about accelerating productivity growth? I mean, we probably need to do all three. So I find that striking. The other point I wanted to make is just that clarity. I think you said workforce shortages, and I think what you really meant was skill shortages. Because I actually think workforce shortages are good for productivity. When companies have a hard time finding talent, they're more likely to automate. You see that, for example, in the fast food restaurant industry now, where there's a lot more automation because you can't get workers. So, do you distinguish between those two factors?
Yeah, absolutely. I think the workforce shortage is very much in the realm of skilled talent, and that's where we see the firms that have done well disproportionately been beneficiaries of attracting skilled talent and deploying that skilled talent appropriately. And on the opposite end of the spectrum, I think workforce shortages, at the margin, will encourage firms to invest in labor augmenting, technologies and equipment and so on. So we think, I think broadly, it's less about workforce in general, but really the skilled labor in particular. And so we focus as much on labor quality and the skill base as we do on number of workers and participation rates in aggregate.
Great, thank you. Also, just encourage listeners, feel free to throw questions into the chat. We'll get to them when we finish our conversation. Luca, what are your thoughts on this? And perhaps also you could just touch on the work you're leading at OECD and how to help policymakers from the 30 OECD nations better understand this question.
Okay, thank you, Rob, and thank you, Charles, for the fantastic presentation. So indeed, I mean, the work resonates with a number of aspects of our work here at the OECD for the last, I would say, about 10 years. And in particular, well, I mean, the OECD is a very complex animal, and there are many of us working on productivity, so I certainly do not claim that I can represent all of them. But let's say that, my take on our work on productivity rhymes very well with what Charles has just presented. And first and foremost, the idea that there are haves and have-nots. I think this summarizes very well what the organization has been finding in its analysis for the last 10 years. Not so much, I would say, across sectors, a little bit across cities and places. Indeed, there's an entire branch of the organization that deals with local level economic growth issues, including productivity divergences, but especially across different types of firms. So we call this the great divergence between frontier firms and non-frontier firms, where frontier firms are those that have, sort of that sit at the top 5% of the productivity distribution, mostly nationwide, but the divergence pattern and an increasing divergence patterns holds true also within a fairly narrowly defined sector. So even among, let's say, firms in the computer production sector, you see a pattern of divergence between the best performance and the not so good performers. But this holds true even for the median producer within a sector. So the median producer, the productivity of a media producer in a sector has been fairly stagnating for the last 10, if not 20 years, while the top 5% has increased, in fact, about 30% more than the laggard, what we call laggards. And so this is the story that we have been pursuing quite actively in terms of both analysis and policies, I would say. And so let's say the areas that Charles has highlighted really sort of touch upon a lot of the determinants that we also claim and we also sort of show play a role in this divergence between frontier and non-frontier firms. I mean, he mentioned them. So first and foremost, the fact that there is relatively stagnating investment. The fact that certain technologies, in particular for what we call like advanced technologies, have been adopted only in few selected firms, once again, the frontier ones. And so we have very limited, or stunted diffusion of key technologies across firms, even within the same sector. But also some, the lack of adequate human capital, which we could extend also to, let's say, what we call managerial capabilities. So the fact that it's not only the skills of workers matter for productivity growth and productivity catch up, but also the skills of managers themselves and how these managers are really putting together like their business within the company. And finally, perhaps the fact that the regulatory framework matters. So there are ways in which policies can not only foster this convergence process, but also simply maintain an active, healthy private sector that grows in productivity. I mean, we can go deeper in each of these areas, but of course, I look forward to the questions from you and the public.
Well, thank you. Yeah, you've both done in your organizations really interesting and groundbreaking work on this whole notion of divergence within a firm, within a sector, with laggards and leaders. What I find really interesting about that question is we still don't really know why. There are a lot of good theories that, can you integrate sort of all the soft parts with the hard technology? We just don't know yet. Then the second, I think, interesting question there is if you talk to people, that leads to potentially two different solutions. One solution is allow more Schumpeterian creative destruction and weed out the losers. I know there's a lot of good work that OECD has done on how certain countries' financial systems prop up the walking dead. Korea in particular, I found a striking OECD data set that the Korean banks, which are encouraged or backed by the government, are just funding these firms that really should die. They have no business being in existence because they're not competitive, but they still lag along. And then there are the people on the other side who are, particularly in the US, but also Europe, what you call neo-Brandeisians, who say, well, we don't want these big leader firms to get even bigger, so we want to throw sand in the stone, in the gears. A little bit like that Greek myth, where the person drops the apple to slow down the person from catching up. How do you look at that question? Do we want to slow down or break up the big guys, or do we want to help the small guys, or where is it all going to go? Or both, or none? Charles?
Well, I'm happy to start from the US perspective and what we looked at. Look, I think there's a general concern that we're seeing slowing business dynamism in the US. And I think there's multiple ways in which you can measure that and start to look at that. We've seen the rates of new firm entry decline quite substantially over the last decade and a half. We've seen lower rates of labor reallocation. If you look at how much labor is moving from across different firms or different establishments within a given sector. The view across some of the literature, at least, is that those things have some productivity impacts, because the rate at which the most productive firms are getting bigger and the least productive firms are shrinking and sending workers away. Clearly, in aggregate, that makes a difference, but those rates seem to be slowing. Now, the more interesting question is why, and I think that's where causality becomes harder to start to disentangle. we clearly see some measures of competition are declining in certain sectors, and that may well be an issue. But I think it's more complicated than general statements. For all that we talk about declining competition in some sectors, there's within many areas of manufacturing, for example, quite heated competition that is as strong as it's ever been. So I think that's an area that we need to explore further, and whether it's competition and the interplay with some of the regulatory framework issues that Luca teed up, I think that is something that's quite important. The last thing I'll say is that this notion of firm size is interesting, and I don't think we've got any point of view around breaking firms up and whether that's going to be beneficial. I think it is worth noting, though, that large firms in general are much more productive than smaller firms. So I think that stands out quite significantly from the data. The question is, I think the interesting question is, are we seeing many of those frontier firms are in fact some of the larger firms in the sector. So it's not at all clear that large firms themselves are sort of the root cause of the productivity slowdown. But I think there is something interesting about, are we actually shaping the ecosystems of firms within particular sectors that are optimal to drive innovation? And I think that's a complicated question, but I think it's worth us exploring, because I think what we do see is the agglomeration effects within sectors are very, very powerful. But when you don't set up either the industry structure, the firm structure in the right way, and then you have kind of geographic proximity to consider as well, I think policy then can either slow down or accelerate some of those agglomeration effects. So I think there's a really interesting set of issues to start to explore further there.
I agree. I just maybe would push back slightly. We did a study, a whole series called Monopoly Myths, where we dug into all this data. And one of the data that we dug into was the startup question. And a couple of things we found is there was no relationship between startup change and concentration in a sector. It just seemed to be orthogonal. But the second was, on net, all the startup loss was in retail. When you get rid of retail, basically the startup have not changed. They've changed in some sectors. They've gone down and gone up in others. And the retail one, to me, is a pretty easy one. Well, that's because of larger firms at e-commerce, and that's productivity. But I agree that dynamic competition and dynamic forces are critical to all this. Luca, what are your thoughts on this question of the laggards, the leaders? How do we think about that question?
Well, I can safely say that I think the general thinking in the organization is of a Schumpeterian nature, right? I mean, so to support market forces so that the selection process cleans the market from the least productive firms, those that shouldn't be there. And in fact, thanks for mentioning the work of the organization on zombie firms, because that was quite a let's say a new set of produced quite a set of new insights. But what I can also say is that we need not choose between sort of productivity growth in frontier firms and those of the laggard firms. In fact, we very much think about this in terms of policy tools that lift all boats at the same time. So perhaps the laggards in a faster way than the frontier firms for the time being. That doesn't mean that there is no understanding. And in fact, I think the OECD has been among the first to show this empirically on a comparable basis across countries, that there may be a stunting of these creative distraction process due to an increasing role of large firms in the economy. So this is a matter that is being currently still analyzed. So I don't think we have reached a final point as a narrative, but we have been seeing, as Charles has already mentioned, across countries this time, like a number of proxies of business dynamism and market power more at large that have pointed towards an increasing concentration of market power. Now we can talk about rates of entry, we can talk about product concentration, we can talk about firm markups, we can talk about profits. I mean, this is all, let's say, for now, indicative evidence. Indeed, it's not incompatible with the idea that these very same firms that are allegedly acquiring market power, also increasing their rate of innovation, right? I mean, so are being so-called superstar firms. So the two narratives are not incompatible, but it's part of our job, I think, to distinguish the two, if for no other reasons that sort of, if it is a market power story, then these companies may be superstars right now, but then not keep on being superstar exactly because they can exploit their dominant position in the future, and at the same time block entry, prevent entry for smaller but more dynamic, more productive, more innovative firms. Rob, I think you're muted.
Sorry, Luca. Thank you. I'm going to push back on that just for the sake of argument, and because I think it's an important issue. There's a lot of narrative about those 3 points: markups, 4 points: concentration, profits, and startups. On the markup issue, first of all, that study that everybody cites is a really deeply flawed study, and we've written on why that, and the reason that is a deeply flawed study is that the numerator is different over time. It doesn't control for the rise of intangible assets. So markups are, as everybody knows here, they're your cost, and then the difference between that and your price. Well, if you don't include the increase in costs of intangibles, you're going to get that wrong. My favorite part of that study was they said that the markup rate for General Electric had grown significantly between 1980 and now, even though General Electric's profit rate went down by a third. Well, clearly those two are incompatible. So number one, that the markup study is, to me, pretty weak. Secondly, on profits, I think number one, you have to look at net profits, and number two, you have to look at domestic profits. So we did that. And if you look at BEA data on profits, corporate profits, what you find is if you take non-financial domestic profits as a share of GDP, they're actually lower than they were in the 60s, where the big growth of profits for the U.S. economy has come from is foreign profits, which not our problem. It's if you think there's a monopoly problem in Italy or something, you can deal with that and squeeze American profits, which is what the Europeans want to do. But certainly not our problem. We want companies to have high profits overseas. And I think, again, you have to also distinguish between financial markets where there are, I think, significant problems. Thirdly, on concentration, when we looked at the Bureau of Census Bureau data on the 2017 concentration ratios, and we compared 900 industries from 02 to 17, what we find was that the C4 ratio, in other words, the amount of sales by the top 4 firms in any of those 900 or so industries, went up by only 1 point, 32 to 33. And if you looked at the most concentrated firms in 2002, in other words, ones that had a C4 60 or above, they actually got less concentrated. So, and then on startups, I think, again, if you look at Scott Stern's work at MIT, what he finds is that there's been no diminution of high growth startups. There's been a diminution of mom and pop startups, but what do we care, really? At the end of the day, they're lifestyle businesses. So not to say we have to argue this all out here, but I really do hope we can have a more in-depth discussion on that, because I see a lot of the narrative as just sort of taking a lot of this for granted. And I think it's way more complicated than the narrative suggests.
Well, I'm not sure if you're expecting a rebuttal or not.
No, I'm not. I'm allowing one. If you would like to make one, I don't expect one. If you'd like to respond, feel free.
I think there is measurement problems. There's no way around it, and sort of in fact, the part that I think we are pushing in this narrative is that in fact, possibly a number of proxies go in the same direction, so that we shouldn't necessarily trust any single one of them, but rather a collection of them. But I mean, this doesn't have to, go into the detail. I mean, there's latitude to improve on measurements on all of them. I mean, our claim is that, the big picture seems to be staying, at least, on a number of countries, right? I mean, maybe the US is not a front runner here, but.
Let me switch gears and talk a little bit about policy, because one of the striking things about economics, so economics basically influences policy. So if you're doing economic policy, you're a member of Congress or the member of the European Parliament, and you say something that violates economic dogma, you're going to be laughed at. You're going to be called an idiot. So I don't think we can underestimate the importance of economics in this. And when you go back and you look at economics textbooks, productivity is hardly mentioned. And certainly endogenous growth and innovation are hardly mentioned. They treat it as an exogenous thing. Paul Romer once said it's the most important thing, but we're not going to do anything about it because we don't understand it. Well, he may not understand it, but I do think we understand it all here. And so I guess my question here would be, on the policy side, we tend to default to fairly generic answers. And I don't mean to say that those generic answers aren't important. If you don't get those right, doesn't matter what else you do on top of it. You have to have the right rule of law. You have to have the right fiscal, monetary climate. You have to have the right educational and skills. You have to have the right amount of scientific research. But it seems to me those are sort of, those are chips to get you in the game. They're not necessarily chips to get you to win. And so my question would be twofold related to that is, how much do you think we need to start, at least on the analytical lens, looking more in depth at particular sectors? One of the things I was always struck by Bill Lewis's work at McKinsey long ago when he looked at Japan is they kind of had the same things we had, the rule of law and all that. But when you looked at some Japanese sectors, performance was phenomenal, and some Japanese sectors were just abysmal. So this can't be climate or economic climate and business environment. They all were in that same pond, if you will. There was something more to it than that. So we still don't seem to have, I know, with the exception, I should say, of McKinsey and maybe OECD, there isn't too much sectoral analysis, like what's really going on there. And I'm just curious if you agree, if both of you agree with me, and if so, how would we address that? Charles?
Yeah, I think it's a great call out, Rob, and it's well, a point well taken at the McKinsey Global Institute, because actually a few of us were dusting off some of the work that was done beginning in the early 90s, where we did quite lengthy country studies and comparing cross-country differences, taking a sector by sector view, and very often looking at more sort of fundamental measures of productivity, number of cars exiting a factory, that kind of thing, to try to break through some of the opacity of the data sometimes, to be able to look at some of these underlying measures. And I think a lot of what was valuable in those studies is it started to highlight the very specific sets of issues around regulation or around industry structure that started to play a role. And I think there's probably an updating of that approach that's appropriate for our current era. Luca talked about the lack of diffusion of breakthrough technologies, and I think using something like a sector approach to really understand why is that happening, and is it what is the binding constraint? Is it around skilled frontline talent? Is it around managerial capital and talent? Is it something about the regulatory environment? Is it something about the financial profile of the firms involved and their ability to access finance? I mean, there's a lot of questions there that I think would be interesting to uncover. I think you're right to point out that I don't think that work's been done, and I think it's been done in areas, and I think there's some research that gives important hints to it, but I don't think it's been done in quite that comprehensive way, and I think it would be beneficial.
Interesting, thank you, Luca.
Yeah, so Rob, I mean, I think this is a very interesting point. I mean, so perhaps by nature of the organization, since we have to, cater on sort of a group of countries at the same time, it's actually difficult to at the same time sort of diversify the countries and the sectors. So go down, I mean, single sectors could be very different across countries, so that adds a little bit of a challenge to our analysis. But there hasn't been a lot of work on productivity at the sectoral level, in the organization. Well, I can say a couple of things, perhaps in your direction. So more recently, there have been a couple of sector-specific pieces of analysis in the organization. One on the semiconductor sector, and another one on the automobile ecosystem. I mean, the focus is not strictly speaking on productivity growth necessarily in these sectors, but it's more of a, let's say like a a growth analysis and what are the factors enhancing growth and more recently resilience in these sectors. And then I can add that, in fact, a lot of our work differentiates by groups of sectors rather than narrowly defined sectors. For instance, we distinguish a lot between manufacturing firms as a whole and services non-financial services firms as a group, market services. So and there, I think, in fact, we do show significant differences in terms of productivity growth. So, I mean, in terms of productivity levels, we know that services tend to be less productive than manufacturing firms because they are more shielded from international competition, because they often they work in direct interaction with the client. But their productivity growth is not necessarily, in terms of growth, not in levels, is not necessarily less important than the manufacturing firms. In fact, when you draw that graph of divergences across frontier and non-frontiers, you see the divergence has been greater since the year 2000 in services sectors than in manufacturing services, and in particular in ICT intensive, or let's say more recently digital sectors. So I think that kind of distinction bear importance to the question of productivity growth and productivity convergence. So it's worth keeping on exploring it.
Interesting. Maybe you should get the Australians to fund a study at the OECD as to why, and I believe this is right, a lot of garbage pickup in Australia is with an automated one-person truck. I look at my garbage pickup in Bethesda, and it's three guys who are really working hard. And I don't mean to say that in jest, because and Charles, I'm sure your work has seen that. If you go around the world, like the best retail stores, are like in Singapore, the best hospitals chain is in some. Right. So it's not like places haven't been able to do it. I think the more interesting question is, why haven't other places adopted it? I mean, clearly these technologies and these work systems pay for themselves and more if you do it right. But we seem to be very, very, and that's not. I don't think that's in this case. It's a monopoly question. It might be a regulatory question because garbage collection is regulated and all. But there's certainly other sectors, electric utilities, all sorts of things that where I find it puzzling that you can have best in global class so far above average.
Yeah, it is quite striking. I mean, we see this, in almost every sector, and I think some of the benefit of a global firm like ours is that we actually do get to pick some of the best in class examples across different countries and have visibility to them. But if you look at, for example, all of the work that our operations practice does around smart factories, and we've mapped this out with the World Economic Forum. There's several thousand sort of plant level establishments that they look at, but the number of what they call lighthouses that are already adopting best-in-class technology and fully utilizing it to its full capabilities, I think at latest count is just under 100, right? And so the question is, well, why aren't there many orders more of those types of kind of leading class factories in the manufacturing sector? And it comes down to, unfortunately, it's it's a multifactorial problem. In some cases, it's these sets of technology challenges we haven't been able to figure out, or we haven't been able to figure out how we reconfigure our operations, our workflows in a way that fully capitalizes this. In some cases, it's we have a J-curve problem. If I borrow that concept from Eric Brynjolfsson and others, which is, we know that we're going to have to make this migration, but over the first few years, the value that we would get from those investments is probably going to be neutral, if not negative, right? It's going to take us a while to fully realize that productivity benefit. And in the meantime, I've got quarterly targets to hit, and so that's a hard trade-off for many managers to make. So I think there's a variety of factors at play. We see, what we see a lot in our digital work at McKinsey is companies that will kind of launch pilots, and they'll do this in one part of the organization, but they fail to scale those because they sort of find themselves in pilot purgatory because for one reason or another they haven't been able within the short enough timeline to show the value and galvanize an entire organization to do the very costly reconfigurations that are needed to fully scale.
That's interesting.
And so I think there's a very interesting set of issues there, and in some cases, we see these breakthrough technologies. We've seen a lot of them in the internet related sector, where you've got positive returns to scale, and these things come up, and then a few years afterwards, everyone's saying, well, why didn't we do that sooner? But for many sectors, the path to adopting all of these technologies and starting to get benefit is inch by inch, yard by yard, and it takes some real work. And I think in some cases companies know what needs to be done, but struggle with how to build the business cases and have the necessary expertise to go and help them on that migration.
That's really interesting, and it gets to the whole sort of short-termism in our companies too short-term. I want to do one question before we break, so we should keep this short. But my view is not enough companies hire McKinsey for their consulting. If they did, they would all be in the lighthouse category. So that's clear. So here's the question: I know we've touched on this a little bit, but many U.S. policymakers are trying to break up America's large firms. Won't this further harm U.S. productivity? Quick response on that? You don't have to get into the politics of it, because there might be other reasons, but certainly the effect, I think, is the real question here.
Yeah, look, I think it's a difficult one to answer precisely. I think we do see that on average, larger firms are more productive when we look at some of the data on this. I think there's a correlation or causation effect there that it's hard to disentangle. I think that there's potential where you've got firms that have real economies of scale that you're going to see some productivity degradation from breaking it up. But I think that's probably too general of a statement to say definitively, yes, that breaking up every large firm is going to hurt productivity. So I think it's something that probably needs to be taken, and particularly where you've got intangible assets, that are playing a big role, which is across most sectors in the modern economy. It does seem to lend itself towards more economies of scale. So that probably gives some reason for being concerned about what the productivity impact would be if we start to break up every large firm.
Great. Yeah, and the flip side of that is merger review. Some mergers are efficiency enhancing, some are not.
Right.
Last question, interesting one. They're all interesting, but this one I really find interesting. Innovation is essential to productivity. We all know that. Clay Christensen, unfortunately passed away, but was a real leader in this, identified three types: efficiency-based, sustainable, and market creating. This question says, the last creates the most, market creating. Do you agree that the last is the most important when it comes to productivity? Luca, you want to go first on that? No, broad question, very complicated, but yeah.
Yeah, so I'm not sure I can make a call across these three types of innovation. Certainly, I mean, the three of them sounds quite necessary on a systemic level. What I can tell you is that there are some, in fact, some of these innovations that are definitely more sort of eye-catching than others, and that the depth of a market does impact productivity. In fact, it was already like in one of Charles' slides, right? I mean, so globalization, with all its faults, does have, I mean, at least in the literature, has had, at least in the literature, like an impact on productivity of firms and productivity growth of firms by sort of enhances the process of selection. So, I mean, so the market creation innovation definitely has a role to push productivity growth. I'm not sure if that's more important than other channels.
Okay, Charles, you have the last word.
Yeah, I agree with Luca's take on that. I think it's I think is the market creating the most important. I think it's certainly the most eye-catching, but I think there's also something to be said for the types of efficiency benefits that we see a lot of innovation creating, and actually over time those incremental efficiency benefits at the level of each firm. I mean, those create a tremendous amount of value creation, even if the big market creating ones are the ones that create outsized financial returns and outsized kind of maybe kind of PR in the sort of marketplace, if you will.
Yeah, I remember really excellent work by what's her name? Carlotta Perez, who was at UK Sussex. Her point was what you find if you believe in Schumpeterian long wave theory, which I do, that innovation goes in waves, that at different points in that cycle, different types of innovation become more important and more predominant. So I think it really is not one of those like one's good and one's bad. It's kind of where are we? What do we need more? And clearly, I think we can all agree, at least we could agree. I'm not sure everybody in Washington could agree that we need more innovation and we need more and faster diffusion, adoption, and creation of firms that are going to do innovation. That is at the center of all of this. So this has been a great conversation. As the viewers could note, I could do this for 8 or 10 or 12 hours. I just think I got a million questions I could ask. There's so much complexity here. It's so important. So I really want to thank Luca and Charles. Really appreciate you joining us, and thank you both for your work. We'll have links to studies that OECD's done on this, and also Charles, I think your report is already up there. So thank you to you, and thank you to everybody who joined us today.